Well, let's now talk about the risks of any investment in general, and of course with a focus here on Tesouro Direto. In general, any type of investment is subject to some types of risks. Let's try to differentiate these risks. Liquidity risk. What is this? You have an asset, and when you try to sell it, you may not easily find a buyer. It is an illiquid asset. As a result, the price of this asset will inevitably decrease. Why? Due to a lack of liquidity or low liquidity. A clear example: a penthouse or a property typically has much lower liquidity than a studio apartment. Since a studio is smaller and cheaper, people tend to trade it more frequently. A penthouse, on the other hand, is more expensive, so not just anyone can afford to buy this type of asset. The same applies to financial assets. In the case of Tesouro Direto, there is no liquidity risk. Why? Because Tesouro Direto itself is committed to repurchasing your bond daily at the price set in the secondary market. So Tesouro Direto does not have liquidity risk. Market risk. Another type of risk is market risk, which is something we have already discussed. The so-called mark-to-market process is, as the name suggests, a market risk. When you purchase a bond, you agree on a certain return. If you hold the bond until maturity, the return will be exactly as agreed. However, if you decide to sell the bond before maturity for any reason, you will be subject to market fluctuations. In this case, the price of the bond may be higher or lower than the one you originally purchased. Thus, in some cases, you may experience a loss, while in others, you may make a profit higher than originally projected. Credit risk. Perhaps the most important risk is credit risk. What exactly is credit risk? It refers to the credit quality of the bond issuer. In the case of Tesouro Direto, why is credit risk very low? Let's compare some situations. In the fixed income world, you can buy a public bond or a private bond. A private bond is issued by a company. Any company can issue bonds. Generally, private bonds offer higher returns than Tesouro Direto bonds. Why? This goes back to the relationship between risk and return. The credit risk of a company, any company, is greater than the credit risk of the national Treasury. There is a concept known as the risk-free asset. In each country, the bond issued by its government is considered a risk-free asset. A good example of credit risk is the role of the FGC, Fundo Garantidor de Credito, Credit Guarantee Fund. Banks in general raise funds by issuing bonds, such as CDBs, certificates of bank deposits. If a bank encounters financial trouble or goes bankrupt, the CDB is guaranteed by the FGC. Many people prefer CDBs over Tesouro Direto bonds because CDBs typically offer higher returns given the higher risk involved. However, some argue that Tesouro Direto does not have FGC coverage. The truth is, it doesn't need it. If you analyze the FGC's portfolio, you'll find that its main assets are public bonds. Why? Because if a bank goes bankrupt, the FGC holds public bonds, which are, by nature, risk-free financial instruments. The FGC can sell these bonds in the market to meet its obligations and guarantee CDB investors. So, in summary, Tesouro Direto does not need FGC protection because the national Treasury itself is the guarantee behind it. Your investment will always be remunerated, and you will receive your payment on the bond's maturity date, or earlier if you decide to sell it. However, remember that selling before maturity exposes you to market risk, while credit risk is virtually non-existent. A hypothetical scenario. Now let's analyze a hypothetical situation. Suppose the government is in a severe financial crisis and Brazil's fiscal situation is worsening. It is unlikely that we will ever reach this point because if the situation starts deteriorating, corrective measures will be taken to prevent it. However, in such a scenario, macroeconomic fundamentals would be in bad shape. The exchange rate would be under pressure, meaning the Brazilian real would lose value against the dollar and other currencies. There would be high inflation. Regarding Tesouro Direto assets, Tesouro IPCA+, since part of its return is indexed to inflation, it would be relatively protected. Tesouro Selic. In a financial crisis, the real would be so depreciated that the central bank would likely have to raise the Selic interest rate significantly, making Tesouro Selic also relatively protected. Tesouro Prefixado, prefixed treasury bond. You would still receive your money, but since its return is fixed, it would be eroded by inflation. Of course, this is a hypothetical, extreme scenario. The Brazilian economy is much more solid today than it was 20 or 30 years ago. I am confident that such situations will not happen again in Brazil. Conclusion. In this Finclay session, we covered the basics of Tesouro Direto, the available bonds and their characteristics, the types of risks involved, the relationship between bond returns and macroeconomic variables. It is important to emphasize that public bonds are an essential tool to include in your investment portfolio. However, they should not be the only ones. Think of your portfolio as a house. Public bonds are the foundation, the cement. With a solid base, you can add other investment instruments and diversify risk. In the fixed income world, there are private bonds. In the variable income world, there are stocks, each with its own characteristics. Public bonds are fundamental, but diversification is key, not only among different government bonds, but across various financial instruments. I hope this helped you build the foundation of your investment portfolio.